Hi, I'm Jennifer Trump. With over 10 years in Central Florida real estate, I'm here to guide you home. Whether you're a first-time buyer or looking for luxury living, I have the market knowledge you need. Let's turn your real estate goals into reality. Contact me today to get started.
Let's talk about mortgage rates in 2026, focused on the ideas coming from President Trump's administration, why they matter, and the practical pros and cons for buyers and sellers in Florida. First, what has been proposed? $200 billion mortgage-backed securities, MBS purchase. President Trump announced a directive for government-linked mortgage entities, Fannie Mae and Freddie Mac, to buy about $200 billion in mortgage-backed securities. How it's supposed to work. Mortgage lenders originate loans and sell them into the secondary market, often to Fannie Freddie. When these entities buy more MBS, demand increases for those securities, which historically tends to put downward pressure on mortgage interest rates by making the market more liquid and predictable. This idea is similar in concept to what the Federal Reserve has done before, but instead of the Fed using its own balance sheet, this plan uses the GSEs, government-sponsored enterprises, balance sheets. 2. Why do people think this could lower mortgage rates? In theory, by increasing demand for mortgage bonds, MBS, investors will accept slightly lower yields. Lower yields on MBS often translate into lower mortgage rates offered to homebuyers. Because the mortgage market is big, multiple trillions of dollars, even a large $200 billion purchase can shift pricing dynamics enough to nudge rates downward. In fact, 30-year mortgage rates briefly dipped below 6% when the announcement was first made. This means buyers feel more encouraged because lower rates equals lower monthly payments, which can increase sales activity. 3. Hidden costs, risks, and criticisms. Size matters. Experts point out that the MBS market is huge, tens of trillions in outstanding mortgages, and $200 billion is small in that context. That means the overall drop in mortgage rates might be modest and temporary, not a long-lasting collapse in rates. B. Increased risk for Fannie and Freddie. Because these purchases would significantly expand the GSE's portfolios, some economists warn this increases risk on their balance sheets. This is important historically because both entities were placed into federal conservatorship after the 2008 financial crisis due to too much risk exposure in mortgage markets. C. Can raise home prices. Lower borrowing costs can stimulate more buyers, but that boost in demand can also drive home prices higher, which offsets the benefit of lower rates. So a buyer might get a better rate, but pay more for the home itself. D. Not a replacement for Federal Reserve monetary policy. Mortgage rates are indirectly influenced by the Federal Reserve's interest rate policy, mainly because mortgage rates follow longer-term Treasury yields, not just what Fannie or Freddie do. So this plan doesn't remove the Fed from the equation. It only adds another force into the market. 4. Other ideas President Trump has mentioned or been linked to. Expanding credit access. There have been discussions around helping more buyers with credit score flexibility or making qualifying easier, but details can vary and often require congressional action to fully implement. Longer-term mortgages. There was talk of expanding mortgage options, like 50-year terms, which could lower monthly payments, but it increases total interest paid over the life of the loan. Targeting institutional buyers. Part of the White House messaging has included trying to limit large corporate buyers from outbidding individual buyers, especially in single-family markets. This can free up supply for regular buyers. But it doesn't directly lower rates, it influences competition for homes. 5. Putting it together. What this means for 2026. Pros for homebuyers. Potential slightly lower mortgage rates if MBS demand pushes down yields. More inventory available if institutional buying is curbed. Greater optimism and buyer confidence in the market. Cons or risks. Limited real impact if the $200 billion is a small portion of a massive market. Could increase home prices, offsetting rate benefits. Adds risk to government-sponsored entities. Doesn't eliminate the Fed's role. Mortgage rates can still trend based on bigger macroeconomic forces. Let me explain it simply in an example. Think of mortgage rates like a giant marketplace. The more buyers of mortgage bonds, the easier it becomes for banks to offer lower borrowing costs. President Trump wants government-linked entities to ramp up their purchases, which can nudge rates lower. But because the market is enormous, this maneuver is more like adding a gust of wind to the sails, rather than a hurricane. It helps, but doesn't control everything.